Welcome back to The Explainer. Today, we're throwing on our detective hats to investigate a genuinely fascinating financial mystery. We're looking at Academy Sports and Outdoors, ticker symbol ASO. You know, in the stock market, when a company looks just incredibly cheap on paper, it's usually one of two things, right? It's either a hidden gem that the market is totally unfairly punished, or it's a value trap, a stock that looks cheap but is actually cheap for a very good reason. So, which one is Academy Sports? Let's find out.
To really get why this stock is grabbing the attention of value investors right now, honestly, you just have to look at this one number, a trailing PE ratio of 9.11. I mean, in a market where you've got retail stocks casually trading at 15, 20, or even 25 times their earnings, seeing a profitable company trading at roughly 9 times earnings is just staggeringly low. It immediately sets up this tantalizingly cheap valuation that absolutely demands a closer look.
So, here's our roadmap for this explainer. We'll start with a valuation snapshot, move into financial health, tackle what I'm calling the cash flow divergence, and finally, wrap up with fair value and dividends.
All right, part 1, the valuation snapshot. Let's look at pricing, ASO.
Based on a recent closing price of around $50, $50.55 to be exact, this stock looks insanely cheap across the board. We already mentioned that 9.11 PE ratio, right? But check this out. The price-to-sales ratio is just 0.54. Basically, you're paying just 54 cents for every single dollar of revenue this company brings in. The price-to-book sits at a super modest 1.51, and the enterprise value to EBITDA, which remember factors in debt and gives us a great look at core operating profitability, is just 5.37. By almost any traditional value investing yardstick you want to use, ASO is sitting squarely in the bargain bin.
And here's the thing. ASO isn't just cheap compared to the broader market, it's cheap compared to its own history. Looking at the current price-to-book ratio of 1.51, we're seeing a really significant historical discount. It's actually down over 14% from its 3-year average of 1.77. In plain English, the market is willing to pay noticeably less for ASO's net assets today than it has over the last 36 months.
Now, that discount is definitely reflected in the recent price action. Closing at $50.55, the stock has honestly taken a bit of a beating lately. The 30-day return shows a sharp, almost 14.5% drop. And if we zoom out just a bit, it's down roughly 19% from its 52-week high of $62.45. Naturally, this recent plunge forces us to ask the million-dollar question. Is this just a temporary dip that we should be buying, or is the market aggressively pricing in a dying business? Well, to answer that, we got to look under the hood.
Moving to Section 2, Profitability and Financial Health.
Look, a cheap valuation is completely meaningless if a company is drowning in debt, right? But if you're worried about bankruptcy risk here, you can go ahead and breathe a huge sigh of relief. A debt-to-equity ratio of just 0.22 means ASO is highly insulated against interest rate shocks. They just rely very little on debt to fund themselves. On top of that, their current ratio is 1.89. That means they literally have almost double the current assets they need to cover their short-term liabilities. So from a sheer survival, balance sheet stability standpoint, ASO is an absolute fortress.
But here's where we start to find a little crack in that fortress. Now, a return on equity of 17.35% is generally pretty darn good, but wait, it's actually down a massive 43% from its 5-year average. Ouch. And even more concerning is the return on invested capital, or ROIC. That's dropped from a 5-year average of 15.74% down to just 9.82%. The so what here is pretty simple. Management is currently generating significantly less return on the cash they reinvest into the business than they used to. Basically, their efficiency is slipping.
Which brings us to Section 3, the cash flow divergence.
When we start digging into the growth metrics, this glaring, almost crazy financial contradiction pops up. Just look at this narrative tension. Over the last 5 years, earnings per share have grown at a compound annual growth rate of over 16%. On paper, that looks absolutely phenomenal. But over that exact same 5-year period, free cash flow has completely collapsed. It's shrinking by nearly 28% every single year. You have to ask yourself, how on earth can a company be rapidly growing its earnings on paper, while the actual physical cash left over at the end of the day is just in a free fall?
This divergence becomes painfully obvious when we look at the trailing 12 months. ASO reported roughly $376 million in net income, but the actual free cash flow they generated, only about $221 million.
Here's the thing. Earnings involve a ton of accounting assumptions, stuff like depreciation schedules, inventory recognition, you name it. But free cash flow, that is the cold, hard cash actually entering and leaving the bank account. When your net income consistently outpaces free cash flow by a margin this wide, it tells us a lot of those reported profits are just tied up in things like inventory or capital expenditures. It's not cash that can actually be returned to shareholders.
Now, okay, to be totally fair here, a free cash flow yield of 6.79% really isn't terrible in isolation. A lot of companies would absolutely kill for that. But as an investor, the trend is your friend, right? And this trend is, well, it's concerning. That 6.79% yield is down a striking 32% from ASO's 5-year average. The underlying business is fundamentally generating less cash relative to its price than it historically has. This sharp deterioration, that's a massive red flag, and it goes a long way in explaining why the market has discounted the stock so heavily.
All right, final part, Section 4, dividends and intrinsic value.
So we've got this rock-solid balance sheet, but deteriorating cash flow. The million-dollar question, what is the business actually worth? Well, before we slap a final price tag on it, we need to see how they reward shareholders in the meantime. The dividend yield is relatively small right now, just 1.19%. However, the growth and the safety of this dividend are phenomenal. I mean, they've grown it at almost 19% annually over the last 5 years. And they can easily afford to keep doing that because their payout ratio is an ultra-safe 9.51%. That means they're using less than 10% of their earnings to pay that dividend, which leaves plenty of wiggle room for future hikes even if earnings fluctuate a bit. For long-term shareholders, that is a huge positive.
Okay, now for the ultimate test. It's time to calculate the fair value price. Our source data actually gives us two starkly different intrinsic value calculations. One model values the company based on its free cash flow trajectory, while the other bases its valuation purely on earnings per share growth. And because of that massive divergence we talked about earlier, you guessed it, these two models give us wildly different answers.
Check this out. The free cash flow model suggests ASO is actually slightly overvalued at today's prices, pinning the fair value at $47.93. So that gives us a negative margin of safety. It's essentially saying, hey, cash generation is shrinking, so the stock should be cheaper. But flip over to the earnings per share model. That one looks at that sweet 16% EPS growth we saw earlier and calculates a fair value of nearly $82. That would imply a massive 38% margin of safety from where it trades today.
So, which model is right? Well, my friends, that is the ultimate puzzle of value investing. ASO is a company with almost zero debt and a management team that is aggressively growing the dividend. But it's also a company facing declining returns on capital and a really worrying drop in free cash flow. So, I'm going to leave you with this provocative question to chew on. At $50.55, does Academy Sports' incredibly strong balance sheet and cheap PE ratio outweigh the risks of its declining cash flows? I mean, is it a brilliant bargain or just a really clever value trap? Let us know what you think, and keep exploring those numbers.